Hey everybody, Marshall Apologist here again. I got a video about something that's been bugging me for a bit now, and that is the X percentage of people own X percentage of wealth. And that's a terrible thing. We'll call it an argument. In any case, a couple of thoughts on that real quick. First of all, wealth and money aren't the same thing. Okay? So, let's presuppose that 2% of the people in the world own 50% of the wealth. Okay, does that mean that they own 50% of the material goods? No. Does it mean they have 50% of the cash? No. No, it means in totality, their overall wealth, which is usually going to be the wealth that they have personally in their own house and property and so forth, as well as the estimated value of the holdings of their business, are worth whatever. So, for instance, if you are Rihanna, you have a lot of material goods. You can afford many material services. You probably have quite a bit in your bank account and investments, okay? But a lot of your wealth isn't going to be any of that. A lot of your wealth is going to be estimated value of your copyrights, of your trademarks, of things that you don't even actually have tangible right now. So for instance, projected album sales currently, what a given album trademark might be worth could be in the millions of dollars that you don't even actually have. You might be getting something like $3 for an album sale, okay? And you might sell 1 million albums. That's $3 million. So if somebody says, oh, this album is worth, $30 million, you might get kind of cross-eyed for a second and go, well, no, if she gets $3 of it per sale and she has 1 million sales, then that's $3 million. But that's not how it works. Because what they're saying is that over the course of this thing, it will earn her a total of $30 million. If she were to sell all the rights that she has, whatever rights those may be, to another person, they are expected to pay $30 million to acquire those rights to that. It's not actually something somebody holds. Now, this might work out in a business in a particular kind of an interesting way. Let's say that you have a business owner and his business brings in $100,000 over the course of so many years, or each year for so many years. His business could be worth as much as $500,000, perhaps even $1 million. That would be lowball it and say $500,000. That would be $500,000 that he's worth as the business owner. It takes a sole proprietorship to keep it simple. But let's just say he makes $100,000 a year in revenue. Okay, now let's just say he makes $20,000 of that in profit. Okay, now that's after paying everybody. That's all your expenses. That's total net actual take-home profit. But let's just say, because he's like a typical business owner, he doesn't actually just cash in that $20,000 every year. He reinvests it. He puts it in stocks, he puts it in bonds, he uses it for research and development purposes, he hires some people to look into some things, he buys new equipment for the business, he expands the building, he buys a new building, he's doing things with that money. Okay, regardless, here are some interesting things about being a sole proprietor of that kind of business, which is the majority of businesses. Let's just say that he's doing that, and he's paying himself a salary of $25,000. Okay, so first of all, if it's a sole proprietorship and the business is making $100,000, he's already in, I think, about the top 5% or so, okay, of all income anywhere. Okay, then you may think, well, what kind of business only does $100,000 a year? Yeah, a lot of them, believe it or not. Really small family-owned businesses can easily do only $100,000. And some business owners really do only pay themselves $20,000 or so a year, and then just from time to time they have other savings that they've either built up or are currently still building up, or just take some out of the company or whatever from time to time when they need it. Regardless of what they report as their income, however, that they actually take home, okay, no matter what their salary is, their taxable income is the entire revenue of the business. All your business revenue is your income. So he's going to take home perhaps $20,000, but he's going to be taxed at whatever the rate of $100,000 is, which all considered is probably about his entire $20,000 worth. He's basically paying his taxes with his income, and that's it. And that's it. Like, that's all he gets. Now, odds are he's got a spouse who works full-time as well and is actually the one supporting the household while they are attempting to have a business grow past $100,000 a year. Okay? So, in that case, they're paying a lot in taxes. They're making very little money. Their income is in about the top 5%, but their wealth is way above that because they have the property, they have the materials in the property, they have the whatever trademarks that they may have, they have whatever customer base they may have. They're going to have all of that, all their experience of their staff and everything else. So if somebody comes in and tries to estimate how much they should sell the company for, if they say, well, your company would be worth, if you sold it today, say $500,000, that is considered their wealth, even though that is not money that they actually have, or even is at their disposal immediately. Okay? So when you say somebody has X amount of wealth, that does not mean that they have X amount of material goods. That means, in theory, were they to liquidate all their assets and sell it to someone else, that's how much they could get for it, if they did that all at once. And that's not quite the same thing as actually having that in hand. And that's the majority of people. Moreover, just because you have wealth doesn't mean that that is not money that is being currently held by another. For instance, if I had, say I had an income of $50,000 a year, I wish I had that income, but let's just say that I did. I don't. But let's just say that I had that income, and let's say that I, either one way or the other, I came by $100,000 worth of investments. Okay? Now those investments would be worth that, and that would be wealth that I would have, even though I don't have it in hand. But my income would only kick in if I actually sell those investments, right? And that would be a different tax bracket and everything like that that would be taxed in. It's a different rate from your income rate generally. But, you know, the issue is that still isn't something that I have materially. But let's just say that I have that $100,000 in various investments. That's not money that I'm holding, and that's not money that some other company is just holding on to. They didn't just go, oh, thanks for your $100,000 and stick it somewhere. No, they took that $100,000 and then they immediately spent it. Immediately. They may have spent it before I even gave it to them. Because that's what lending is. Much like in a previous video, all lending is spent immediately because all lending is borrowing, and all borrowed money is spent immediately. They don't just stick it in a safe, right? That would be dumb. They wouldn't be able to make interest on it through any sort of means and then pay you back more. So, you know, that is also how a lot of this wealth works. So somebody like, I don't know, Bill Gates is a bad example. I don't know, some rich guy, right? Trump, I don't know. Doesn't really matter. You know, they may have however much that they have in investments and everything, but that isn't money that's just stagnantly theirs. That's money that's in an innumerable amount of other companies that are paying employees salaries, benefits. Those are being spent at stores and all manners of things. So, but that's still technically their wealth. So if they that's an asset that if they liquidated it, they would be able to get that much for it. So the issue of all these people have this much wealth and therefore no one else has any is dumb. We're all, in a roundabout way, kind of living off of everybody else's wealth, while also having a little bit of our own, right? If you actually own real estate, or there's stuff in your house, if you don't owe money on it or whatever, that's all part of your wealth. You know, your total liquidated assets minus your debt is your wealth currently. So, you know, the idea that you can just say, well, they have all this wealth, that means they have all this income, and therefore income is distributed wrong and whatever, is a gross oversimplification of the issue, and it really needs to stop. There are some very bad reasons why some people have so much wealth, but there are also some very good reasons that people have so much wealth. And it's not simply so black and white as they're taking all the wealth and we don't have any of it because they're stealing it. That is just dumb. Don't think that.